The internal memo that started the debate did not use the word monetization. It referred instead to balance sheet policy transmission and asset purchase programs. The memo was drafted in the research department of a major central bank shortly after the first wave of bond buying, launched in the wake of a financial crisis. Its key sentence was simple. Measures currently described as temporary responses to market dysfunction will, if prolonged, alter the de facto relationship between the central bank and the fiscal authority. In plain language, the authors were saying that if the central bank kept buying government debt without a clear exit plan, it would become the funding arm of the Treasury. At the time, the concern sounded abstract. The program had a defined size and an end date. The official line was that the central bank was only restoring market functioning, not financing deficits. The evolution from temporary program to permanent regime happened in stages. The first stage was crisis response. Markets froze. Governments needed to issue large amounts of debt quickly. Traditional investors were unwilling or unable to absorb the supply at prevailing yields. Central banks stepped in as buyers of last resort, purchasing government bonds in the secondary market. The purchases were justified as a way to stabilize financial conditions and ensure that monetary policy could be transmitted even when short-term interest rates were at or near zero. There was a clear narrative. This was extraordinary action for extraordinary times. The second stage came when the immediate crisis passed, but the programs did not fully unwind. Instead of selling the bonds back into the market, central banks reinvested maturing securities, keeping their balance sheets large. What had been an emergency stock of assets became a baseline. The third stage was normalization that never arrived. Central banks signaled that they would gradually reduce their balance sheets once growth returned and inflation stabilized. They published plans for quantitative tightening, laying out schedules for letting bonds mature without replacement. Markets reacted nervously each time such plans were announced. Yields rose, equity prices fell. Liquidity indicators flashed stress. In response, central banks slowed or paused their balance sheet reduction. In some cases, new shocks, pandemics, geopolitical tensions, energy price spikes provided fresh justifications for renewed purchases. Each new episode reinforced a pattern. Whenever financial conditions tightened too quickly or government borrowing needs surged, the central bank resumed large-scale asset purchases. The line between monetary policy and fiscal backstop blurred. From a legal perspective, most central banks are prohibited from directly financing government deficits. They are not allowed to buy bonds at auction or extend overdrafts to treasuries. The workaround is secondary market purchases. The central bank buys bonds from banks and other investors after issuance, not from the government itself. Formally, this maintains a separation, the market intermediates between fiscal and monetary authorities. In substance, when the central bank reliably absorbs a large share of new issuance, the effect is similar to direct financing. The key difference is optical. The government sells bonds to the market. The central bank buys bonds from the market. No law is technically broken, but the end result is that a sizable portion of public debt ends up on the central bank's balance sheet, financed by reserves that the central bank creates. Independence, in this context, becomes a question of degrees rather than absolutes. A central bank that sets short-term interest rates, but also purchases large amounts of government debt, is formally independent but structurally constrained. If it raises rates sharply to fight inflation, the market value of its bond holdings falls. The fiscal authority faces higher debt service costs. Banks that hold government bonds suffer mark-to-market losses. Pension funds and insurance companies see their portfolios decline. The feedback from these sectors comes back to the central bank in the form of political pressure and financial instability concerns. Over time, The institution internalizes these constraints. Policy choices are made with an eye to the impact on the government's financing conditions and the stability of institutions that depend on low yields. The original memo's warning that the relationship between central bank and fiscal authority would change quietly becomes reality. The mechanics of balance sheet monetization are straightforward. When a central bank buys a government bond, it pays by creating reserves, liabilities of the central bank that sit in the balance sheets of commercial banks. The government bond moves from the market to the central bank. The net effect is that the public sector as a whole has swapped one liability, the bond, held by private investors, for another liability, reserves, held by banks. The consolidated public balance sheet has not shrunk, it has changed composition. What matters is how long this arrangement persists and under what conditions. If the central bank later sells the bonds and extinguishes the reserves, the process is reversed. If it holds the bonds to maturity and rolls over the proceeds into new bonds, the monetization becomes long-term. The central bank is now a structural holder of public debt. Why does this become difficult to stop? The first reason is scale. Once a central bank has accumulated bond holdings equal to a large share of GDP, unwinding those holdings requires either finding private buyers willing to absorb the supply at reasonable yields or accepting a sharp rise in rates as the market adjusts. In highly indebted economies, a rise in yields quickly translates into higher debt service costs for the government. Budget projections worsen. Debt sustainability comes into question. Politicians face a choice between fiscal tightening, which is unpopular, and pressure on the central bank to pause sales or resume purchases. The temptation to treat the elevated balance sheet as a new normal is strong. The second reason is path dependence in financial markets. Over years of asset purchases, investors adapt to the presence of a large, price-insensitive buyer. Portfolios are built on the assumption that government bonds will remain liquid and that central banks will step in during periods of stress. Public and private balance sheets become intertwined at the yields produced by the purchase programs. Mortgage rates, corporate bond spreads, and equity valuations all embed the low-rate environment. Removing the central bank as a buyer is not just a technical adjustment, it is a regime shift. It reprices a wide range of assets, not only government bonds. That repricing can trigger deleveraging, margin calls, and fire sales. Central banks, faced with such instability, have historically chosen to slow or reverse normalization. The third reason is institutional narrative. For decades, central banks have cultivated a reputation as technocratic, apolitical entities that adjust policy based on macroeconomic data. Admitting that bond purchases have become a quasi-fiscal tool would undermine that narrative. Instead, the language used to describe balance sheet policies emphasizes market functioning, inflation targeting, and financial stability. When governments run large deficits and issue substantial debt, and when central banks buy that debt, both sides maintain that each is acting independently within its mandate. There is no explicit coordination, only a shared understanding that disorderly markets or sudden increases in yields would be undesirable. This mutual awareness creates an implicit coordination even in the absence of formal agreements. A fourth factor is the distributional impact of reversing monetization. Low yields and large central bank balance sheets benefit certain groups. Governments, which face lower borrowing costs, existing borrowers who can refinance at low rates, and holders of long-duration assets whose values rise. Reversing these policies imposes losses on those same groups. Governments must allocate more revenue to interest payments or cut spending. Households and firms face higher borrowing costs. asset prices adjust downward. The groups that lose from normalization often have significant political or economic influence. They lobby, directly or indirectly, for continued accommodation. The groups that would benefit from normalization, future savers, potential new investors, and those harmed by asset price inflation, are diffuse and less organized. Finally, there is the issue of precedent. Once a tool has been used successfully to avert a crisis, it becomes part of the standard toolkit. The first time a central bank launches a large-scale asset purchase program, it is presented as extraordinary. The second time, it is described as a proven instrument. The third time, it is almost expected. Markets begin to assume that in any serious downturn or fiscal stress episode, the central bank will expand its balance sheet. Governments plan budgets on the implicit assumption that demand for their debt will remain strong, supported if necessary by policy. Over time, what began as an emergency bridge becomes the main road. Ending the practice would require not only technical adjustments, but a deliberate decision to break expectations that have been built over many years. Taken together, these elements explain how temporary bond purchase programs evolved into enduring features of the monetary landscape and why reversing them has proven so difficult. The institutions involved retain their formal independence, but their choices are bounded by the fiscal realities of highly indebted states and the expectations of markets that have grown used to a backstop. The question that remains open is how long a system built on this form of quiet monetization can operate before either inflation, political backlash, or a loss of confidence forces a different arrangement, and who will bear the costs when that transition finally occurs. In the internal discussions that accompanied the first waves of bond purchases, some staff economists raised a classic concern: fiscal dominance. In a fiscally dominant regime, the central bank's choices are constrained by the government's financing needs rather than by inflation and output objectives. The memo literature inside several institutions now quietly acknowledges that the line between fiscal and monetary dominance has blurred in highly indebted economies. When interest rates are kept low, primarily because higher rates would render public debt trajectories unsustainable, the central bank is no longer an independent actor optimizing macroeconomic outcomes. It is part of a consolidated public sector balance sheet that must be kept liquid at almost any cost. Another under-discussed dimension is the impact of balance sheet monetization on central bank solvency itself. When a central bank holds a large portfolio of long-duration government bonds and raises policy rates to fight inflation, the market value of those bonds falls, while the interest it pays on bank reserves rises. In extreme cases, this can generate persistent operating losses and negative equity. Legally, a central bank cannot go bankrupt in the same way a private institution can. It can always create more of its own liabilities, but negative equity can damage credibility and invite political interference, especially if governments are asked to recapitalize the institution. To avoid this, central banks face an incentive to move cautiously on rate hikes and to accept a slower disinflation path than pure models would suggest. The spillovers to emerging markets form a third layer of consequence. When major central banks in advanced economies expand their balance sheets, global liquidity conditions change. Capital flows into higher yielding assets in developing countries, compressing spreads and encouraging those governments and corporations to borrow more. When balance sheet policies eventually tighten, even modestly, these flows can reverse, leading to currency depreciation, higher external borrowing costs, and in some cases, sudden stops. Emerging markets thus experience the monetization cycle in advanced economies as an external shock that they did not choose and cannot control, but must nonetheless manage through their own monetary and fiscal tools, which are far more limited. Over time, This environment also distorts private sector behavior in subtle ways. Prolonged periods of low yields and predictable central bank support encourage leverage and risk-taking. Firms that would not be viable under normal financing conditions survive by rolling over cheap debt. Asset managers chase returns in ever more complex instruments, confident that a major dislocation will trigger policy support. This dynamic creates what some researchers call a central bank put, embedded in market psychology. The more often support is provided, the stronger the belief becomes. Breaking that belief would require allowing a downturn to proceed without intervention, accepting deeper short-term pain to restore long-term discipline, something no major institution has yet been willing to test in full. The legal architecture surrounding bond purchases has also adapted. After early controversies over whether large-scale asset purchases violated prohibitions on monetary financing, many jurisdictions clarified statutes or issued legal opinions that framed such programs as consistent with central bank mandates, provided they were aimed at price stability or financial stability. These interpretations gave cover for repeated use of the tools. They also narrowed the space for legal challenges by groups concerned about the constitutional implications of quasi-fiscal operations conducted by unelected bodies. With the legal questions largely settled in favor of flexibility, the remaining constraints on monetization are political and reputational, not statutory. In the background, a quiet discussion continues among some policymakers and researchers about possible exit architectures. Proposals range from gradual runoff of bond portfolios over decades to the permanent recognition that a portion of the public debt held by central banks will never be unwound in practice and should be treated as effectively retired. Each option carries trade-offs for inflation expectations, market functioning, and perceptions of central bank independence. For now, none of these proposals has moved from internal papers to actionable plans. The system continues to operate on an implicit understanding. Balance sheets will stay large, purchases will resume when needed, and formal independence will be preserved in language even as practical constraints tighten. The unresolved question is how long this arrangement can persist before a shock, whether inflationary, political, or financial, forces a more explicit reckoning with what monetization has already done to the structure of modern monetary regimes.